Most people are losing a game they do not even realize they're playing. You wake up at 6 in the morning to the aggressive blare of an iPhone alarm. You chug a stale Starbucks cold brew to shock your central nervous system into compliance. By 8:30, you are logged into Slack, staring at a wall of notifications and syncing with East Coast market hours. You trade your life force for a digital paycheck, telling yourself that the next promotion, the next standard issue corporate bonus, or the next slight bump in your salary will finally buy your freedom. It is a mathematical illusion. You are running on a treadmill that accelerates faster than you can sprint. The modern American economy is explicitly designed to keep you trapped in this loop. We have been conditioned to believe that the solution to financial anxiety is simply making more money. That is a lie. The system does not care how much you earn. It only cares how much you consume. If your income scales from $80,000 to $200,000 a year, but your lifestyle automatically upgrades to match it, your net position remains exactly zero. You have merely traded an economy-class trap for a first-class cage. Consider the fundamental biological machinery operating beneath your daily decisions. Your brain is an ancient survival engine running on primitive chemical algorithms. It did not evolve to navigate high-frequency digital capitalism. It evolved to seek immediate, short-term rewards while conserving raw physical energy. When you survive a grueling 10-hour day of Zoom fatigue and passive-aggressive emails, your brain demands a compensatory hit of dopamine. It wants a release valve. This is why you mindlessly order a $40 late-night DoorDash delivery while scrolling through real estate listings you cannot afford. This is why you grab the free glazed donuts in the corporate break room, chasing a temporary metabolic spike to mask your chronic lack of fulfillment. Psychologists call this cognitive dissonance. You consciously want financial independence, but your subconscious wiring demands immediate survival comfort. The system exploits this evolutionary glitch with terrifying efficiency. Social media algorithms, targeted advertisements, and frictionless one-click Apple Pay checkouts are optimized to separate you from your capital before your rational mind can intervene. You are fighting a war against elite data scientists whose sole job is to keep you broke, and you're trying to win it using nothing but raw, exhaustible willpower. It's like holding your breath underwater for an hour. You will lose every single time. To break the loop, you must first unlearn the foundational cultural myth of the American middle class. We are told to go to school, get a secure job, buy a suburban home, and contribute to a traditional retirement fund for 45 years. This framework is a relic of an industrial era that no longer exists. Today, clinging to the illusion of job security is the single highest risk financial strategy you can deploy. Your corporate employer views you as a line item expense on a profit and loss statement. If the macroeconomic climate shifts, or if an automated software suite can do your job for 10% of the cost, your position will be deleted before the afternoon sink. True financial security does not come from having a high-paying profession. It comes exclusively from owning income-producing assets that do not require your physical presence to operate. There is a rigid distinction between your profession and your business. Your profession is the specialized skill set you sell to a company in exchange for a temporary paycheck. Your business is the collection of assets you build in your asset column. Most people spend their entire adult lives minding someone else's business. They work to make their CEO rich, they pay the highest tax brackets to the government, and they hand over interest to banks via massive mortgages on properties they mistakenly classify as assets. Let us look at a house through a cold, analytical lens. The typical professional views their primary residence as their largest investment. This is an objective accounting error. A true asset puts money into your pocket every single month. A liability takes money out of your pocket. Your home demands continuous cash outflows. It requires property taxes, interest payments, homeowners association fees, structural maintenance, and insurance. It is a massive liability disguised as wealth. The only time a house becomes an asset is when it generates a net positive rental yield after accounting for all operational costs. Until then, it is an expensive consumption item that locks you into a specific geographic location and forces you to stay chained to your desk to service the debt. The masses are functionally illiterate when it comes to cash flow. They look at the size of their salary, while the wealthy look exclusively at the structural composition of their balance sheet. If you stop working today, how many days can your current asset column sustain your baseline lifestyle? That's the true metric of wealth. Everything else is just status theater designed to impress people who are equally broke. The trap operates through two primary emotional levers: fear and desire. Fear is the initial driver. It is the raw anxiety of not being able to pay your rent, cover your car note, or survive an unexpected medical emergency. This fear drives you to accept a corporate position, log into Microsoft Teams every morning, and tolerate an environment that drains your brain's battery. But once the direct paycheck hits your account and the immediate fear subsides, the second lever takes over. Desire fills the void. Your brain registers a financial surplus and immediately seeks luxury consumption. You buy a newer vehicle, subscribe to premium streaming services, upgrade your apartment, and go out for expensive weekend brunches. This sudden increase in spending creates a higher baseline cost of living. To maintain this new lifestyle, you now need a larger injection of cash. The fear returns, sharper this time because the financial stakes are higher. You must now work harder, secure a raise, or take on more corporate responsibility. When you get the raise, the desire kicks in again, and the cycle repeats. This is the classic rat race. It is a self-inflicted closed-loop system powered by unmanaged emotions. Money does not solve this problem. Giving a financially illiterate person more money is like giving a terrible driver a faster sports car. It only accelerates their arrival at the eventual crash. Look at the structural rules of the game. Individual W-2 wage earners are the most heavily taxed demographic in the United States. The system is structurally engineered to penalize human labor while rewarding capital ownership. As a corporate employee, your financial flow is entirely linear and highly inefficient. You earn a gross salary, the government immediately takes its cut via automatic payroll withholding taxes before you ever see a dime. Then you spend what's left on your fixed baseline costs, rent, food, and student loans. Finally, you try to save or invest the tiny fraction that remains at the bottom of the funnel. You are playing the game on maximum difficulty. The wealthy utilize a completely different sequence because they operate through corporate legal entities. A corporation earns gross revenue from its operations or assets. It then spends that revenue on all valid, legal business expenses, software tools, equipment, travel, and operational infrastructure. Only after all those expenses are paid does the corporation pay taxes on the net profit that remains. The individual works, gets taxed, and spends. The corporation works, spends, and then gets taxed. This is not a loophole. It is the basic legal design of the modern tax code, explicitly structured to encourage investment and business formation over passive wage reliance. If you are a solopreneur or an online business owner, you are not automatically immune to this trap. Many digital founders simply trade a corporate boss for a collection of demanding clients. They build a freelance business that relies entirely on their daily active labor. If you have to show up every day to manually write the copy, build the website, or run the ad campaigns, you do not own a business. You have simply built a high-stress, low-security job.
Where you are the most demanding boss you have ever had, you are still trading a unit of time for a unit of money. True scale requires you to decouple your income from your personal hours. You must learn to build systems, design automated frameworks, and create intellectual property that converts your knowledge into an asynchronous digital product. If your revenue generation stops the moment you turn off your laptop, your financial architecture is fundamentally fragile. The transition from a time-dependent wage earner to an asset owner requires you to develop a high tolerance for calculated discomfort. You must become completely indifferent to the opinions of the masses. The crowd will always advise you to play it safe, diversify into low-yield index funds, and wait 40 years for a modest corporate retirement. That advice is designed to produce average results, and in the current economic landscape, average means broke. To win big, you must initially be unbalanced. You must concentrate your limited time, attention, and capital into building a hyper-focused asset column before you start indulging in luxury consumption. Winners analyze, while cynics criticize. The average person will look at a business opportunity, find 3 minor reasons why it might fail, and use that doubt as an excuse to log back into their streaming account and remain passive. They focus on the potential friction rather than the structural payout. They allow their cynical self-doubt to keep them safely on the sidelines, watching other people move boldly forward while they console themselves with the false comfort of job security. To execute this transition effectively, you need a pragmatic protocol that integrates directly into your current US-based reality. You cannot rely on vague philosophical concepts or outdated real estate strategies. You need a system that respects your time constraints, addresses your corporate office dynamics, and utilizes modern tools. The blueprint is broken down into 3 distinct, non-negotiable operational sequences that you can begin implementing immediately after this video concludes. The first phase is the asset construction protocol. Your immediate goal is to build a digital cash flow engine using the exact professional knowledge you are currently giving away to your employer for a flat salary. Look at your daily corporate tasks. You are likely managing complex cross-functional workflows in Notion, drafting high-converting sales sequences, structuring technical data pipelines, or optimizing operational systems. These internal frameworks have massive commercial value to mid-level professionals and smaller businesses who lack your specific expertise. Do not offer live consulting or manual freelancing services. That is just another time-for-money trap. Instead, package your expertise into an asynchronous digital product that sells while you are asleep or checked in to a morning quarterly review. Start by auditing your specialized corporate skill set. Identify one highly specific operational problem you solve consistently at your day job. For example, if you are a project manager who knows how to keep messy product teams aligned, your asset is not your time. Your asset is the specific, optimized workspace architecture you designed to make that alignment happen. Replicate that structure inside a clean, standalone Notion framework completely separate from your employer's systems or data. Ensure it contains 0 proprietary information, 0 company IP, and 0 restricted data. It must be a pure, functional methodology built entirely from scratch using your personal insights. Once your digital product is built, you must establish an automated, low-maintenance acquisition pipeline. Do not spend money on complex ad campaigns or high-ticket marketing agencies. Use organic, professional distribution networks like LinkedIn. Write 3 structured, analytical posts per week, breaking down the exact operational errors you see companies make in your niche. Do not use generic, hyped-up marketing language. Write like a cold, precise operator who diagnoses problems with surgical accuracy. At the bottom of each post, include a clean, direct link to your digital product landing page. Host this product on a checkout platform like Gumroad or Lemon Squeezy to completely automate the fulfillment process. When a user clicks your link, processes a payment via Apple Pay or Stripe, the platform automatically delivers the file to their inbox. Your physical presence is entirely extracted from the transaction loop. You are converting your knowledge into an independent, scalable digital asset that operates completely outside your 9-to-5 working hours. The second phase is the corporate tax shield protocol. As your digital product begins generating secondary income streams, you must immediately transition from an individual financial structure to a corporate structure. Do not allow this secondary revenue to mix with your personal checking account. If you do, it will be subjected to standard personal income tax rates, destroying your capital efficiency. Go to your state's online corporate filing portal and establish a domestic single-member LLC. This process takes less than an hour and costs a minimal state filing fee. Once your articles of organization are approved, go directly to the IRS website and generate a free employer identification number. Take this document to your bank and open a dedicated business checking account. Link it exclusively to your Stripe or checkout platform. Every single dollar of revenue generated by your digital asset must flow directly into this corporate silo. Now you can legally implement the corporate cash sequence. Your business checking account is now a structural shield. Before you transfer any net profit to your personal account, you will deduct all valid, ordinary, and necessary business expenses required to keep your digital asset running. Think about your current monthly expenses through this legal framework. The premium AI tools you use to write content, the workspace subscriptions you use to host your products, the home internet connection you use to manage your platform, and a portion of your smartphone bill are now legitimate corporate overhead costs. If you buy these tools as an individual, you are using post-tax dollars. If your LLC pays for them, it uses pre-tax revenue, lowering your overall taxable income. You are now spending first and paying taxes only on what remains. You have legally aligned yourself with the exact financial rules used by the modern financial elite. The third phase is the enforced scarcity protocol. The moment your digital asset revenue combines with your primary 9-to-5 salary, you will face an immediate psychological threat, lifestyle creep. Your survival brain will see a rising balance in your checking account and instantly attempt to deploy it on premium comfort items, better vehicle leases, or luxury food delivery apps. You must ruthlessly short-circuit this biological algorithm by creating artificial resource scarcity.
Log in to your primary corporate payroll portal or your main bank account. Set up an automatic recurring routing rule that triggers the exact morning your 9-to-5 paycheck hits your account. Program it to immediately skim 15% of your gross income and transfer it completely out of your primary checking environment before you ever have a chance to look at it. Split this capital across 2 high-efficiency investment channels. The first portion must go directly into your employer-sponsored retirement account or a personal tax-advantaged account to capture any instant corporate matches. The second portion must route automatically into a dedicated brokerage account set up to purchase broad market index funds or high-yield real estate investment trusts. By automating this sequence on day 1, you strip your daily checking account down to a lean, functional baseline. When you open your banking app, your conscious mind sees a low, restricted balance. Your brain registers scarcity. It stops fantasizing about expensive weekend upgrades or luxury purchases because it perceives a lack of fluid capital. You are forcing yourself to live strictly below your means, while your automated wealth pipeline compounds capital silently in the background. If you want to increase your personal spending money, you cannot do it by working longer hours at your day job or begging for a cost of living raise. The only way to increase your fluid cash is to optimize your digital asset engine and make your business scale. You're leveraging your own psychological survival mechanisms to force continuous financial growth. This is the end of the theoretical breakdown. The economic rules of the game are completely transparent, totally indifferent to your feelings, and entirely mathematically predictable. You can choose to remain an emotional participant, running the corporate rat race until your battery is completely spent. Or you can choose to operate like a system engineer. Treat your personal life like a laboratory. Implement the digital asset protocol, establish your corporate shield, and enforce absolute automation on your capital routing. Stop talking about financial freedom. Stop complaining about your corporate workload, and go execute the blueprint right now.